Hello everyone and welcome back to the MSA channel. I'm Harm Hoonstra, Director and Deputy Head of Corporate Services at MSA. Today we're diving into an essential topic for any business operating in China, value-added tax. China's VAT system is known for being complex and has undergone significant changes in recent years, with more reforms expected in 2025 and 2026. For foreign companies, understanding how VAT works is crucial to stay compliant and avoid costly mistakes. Whether you're selling products, offering services, or planning your finances, VAT is at the heart of it all. In China, there are two categories of VAT taxpayers: general and small scale. Companies with annual sales above RMB 5 million are classified as general taxpayers, while those below the threshold fall under small-scale taxpayers. Though, if those companies want, they can apply for general status if it benefits their business. The key difference between these two is that small-scale taxpayers pay a simplified VAT rate of 3%, which currently, under a temporary policy, has been reduced to 1% until the end of 2027. Additionally, if small-scale taxpayers, their sales stay below RMB 150,000 per month or 450,000 RMB per quarter, they're fully exempt from paying any VAT. Furthermore, another key difference is that small-scale taxpayers cannot deduct input VAT. However, they can still issue special VAT invoices called Fapiaos to their customers if approved by the tax bureau. General taxpayers, on the other hand, have different VAT rates depending on the type of goods or services provided. The most important and most common rate, 13%, applies to most goods, whereas a rate of 9% applies for specific industries such as logistics, real estate, and catering. Then there's the rate of 6% for modern services such as IT, finance, and consulting. In addition, exports benefit from a 0% VAT rate, meaning that VAT is levied but refunded, effectively making these goods or services VAT-free. To explain a little bit more on a topic that I just mentioned, the Fapiao is China's official VAT invoice and is central to doing business in the country. Unlike in other jurisdictions where invoices are created freely, Fapiaos are issued and monitored through the government's tax system. There are two different types of Fapiao. Firstly, there is the special VAT Fapiao, which is mostly used by general taxpayers, and this allows the customers who receive this Fapiao to claim input VAT credits to be deducted from their output VAT. The second type is a general VAT Fapiao, which is typically issued by small-scale taxpayers. The main drawback of this is that this does not allow for input VAT deduction by the party who receives this. In the past, Fapiaos had to be issued on special invoicing equipment, like a specific type of paper issued by the government on a government-issued computer or like printer, and businesses needed government authorization to be able to issue Fapiao in this way. However, in most places in China, this system has since been digitalized, making the issuing of Fapiao and receiving of Fapiao a lot easier. A key point to note on the topic of Fapiao is that misuse or failure to issue Fapiao properly can lead to severe penalties and fines, and the digitalization of this system has made it more easy for authorities to monitor any misuse. All companies must register for VAT with the local tax authority and continuously issue VAT invoices known as Fapiaos. Registration requires a number of key documents of the company, such as the business license, the legal representative's ID or passport, bank account details, and proof of accounting records. After registration, the company is required to issue official Fapiaos for all of their taxable sales. On the topic of compliance, companies must file VAT returns either monthly or quarterly, depending on their taxpayer category. For example, general taxpayers and larger companies may be required to file on a monthly basis, whereas smaller companies will file on a quarterly basis. These filings include reporting sales VAT collected, and any input VAT deductions to arrive at a VAT payable. Compliance with all these regulations requires meticulous bookkeeping and accurate reconciliation of company records. For exporters, China operates a VAT refund system. This means that VAT is first paid, but can be refunded, effectively reducing the rate to zero. However, claiming this export VAT refund can be complex. It requires valid export documentation, including customs filings and approved Fapiaos. And the refund that you receive will depend on a refund rate and will vary by product category. However, majority of products fall under the 13% rate, although some do fall under a 9% rate. In December 2024, China finally passed its first comprehensive VAT law, set to take effect on January 2026. This law consolidates existing rules and regulations into a unified framework and clarifies key aspects like tax rates, eligibility, and exemptions. Furthermore, during 2025, the government also released further explanatory regulations on changes that are upcoming. One of the most significant changes is the simplification of the small-scale taxpayer regime. Historically, small-scale taxpayers faced either 3% rates or 5% rates and couldn't deduct input VAT. Now, with the new law coming into effect in 2026, this will be streamlined into a single 3% rate, making the system simpler and potentially reducing costs for many businesses. Other significant updates in the new law include restrictions on input VAT credits for high-value assets above 5 million RMB, updated rules for mixed sales transactions, and new requirements for annual reconciliations. So for foreign invested companies, these changes are crucial as they will directly impact VAT planning and compliance strategies. China's VAT system is evolving, but that evolution brings both challenges and opportunity. Whether you're a startup just launching operations in the market or a multinational scaling investment, staying ahead of VAT reforms can unlock real advantages. If you'd like tailored advice on VAT compliance, optimization, or preparing for the 2026 reforms, visit our website or reach out to us directly. Thanks so much for joining us today. Make sure to subscribe to our channel for more insights into doing business in China. Thank you.